If you look at the data over the last quarter, what you see is stronger than expected growth, a tighter than expected labor market, and higher than expected inflation. So that tells us that although policy is restrictive, it may not be restrictive enough, and it has not been restrictive for long enough.
Our next guest says she's expecting a hike in July, but thinks the central banks need to, quote, break the back of employment to truly tame inflation.
Investors should fight the Fed at their own risk. Given the Fed's continued hawkish stance since the June meeting, the possibility of further rate hikes is strong.
Hello and welcome back to my channel. Bitcoin just completed a technical chart pattern that may indicate the start of another major bull market. Additionally, with the Fed likely cutting interest rates, a Bitcoin ETF in the pipeline, and a new credible exchange, it might be time to get involved. So, what's going on with the U.S. market and economy? In today's video, Raoul Pal has shared his insights on the current U.S. market, where he has discussed points like Bitcoin, interest rates, inflation, and recession. To know more details, stay tuned till the end of the video. And if you want to stay up to date with the latest crypto insights, markets, and economy, make sure to hit that subscribe button and the bell icon. All right, are you ready? Let's dive right in.
There's a big narrative right now saying as soon as the Fed stop, inflation's going to go up, right? That's the most pervasive narrative in financial markets. I don't believe that narrative, but their job is to manage inflation expectations. So they want to do this hawkish, and they've done this before, the kind of hawkish pivot, which we're going to pause, but we're going to come back and beat you over the head if you dare think inflation's going to go up and try and price it. Now, that's not uncommon. Alex Gurevich wrote about this recently. That's a pretty standard way that the Fed operate. 2019, 18, when they paused in December, similar kind of narrative. It's like, we're watching you guys, we'll come back and beat you over the head. But every single time the Fed have paused, the next move has been a cut. I mean, 100% of the time. Look at the global manufacturing PMI that just came out. It's at 46.3, which is full recession territory. So, if the ISM, my view is the ISM, which is about the same level, 46 point something, I think it'll end up being somewhere in the low 40s. I mean, that's a good enough signal there's ever been that the Fed need to stop. I mean, all of my forward-looking indicators show inflation is imploding. All of them show that unemployment's about to rise. All of them show that rents are going to come down. All of them show that wages are going to come down. I don't see what everybody's talking about. People are just pulling up a chart of the 1970s and saying, oh, that inflation's going to come back differently, because they're trying to impose a narrative.
If you've been wondering about the Federal Reserve's next move after their recent string of 10 consecutive rate hikes just 2 weeks ago in June, hold on tight, because there's more to come. Chair Powell's statements in the news conference went beyond what we expected. He suggested that there's still more work to be done in the fight against inflation and tightening policy. It seems like the Fed is not done yet. Now, according to Raoul Pal, his indicators tell him that inflation is going down, unemployment is going up, rents are going down, and wages are going down too. So he doesn't get why there is so much talk about inflation coming back, with some people showing charts from the 1970s. He believes that it seems like people are trying to push a certain story instead of looking at the real signs and facts. So what do you think? What will be the Fed's next decision? Let me know your thoughts in the comments below. Let's jump into the next clip for more details.
Always the same thing. They've got two mandates, inflation and unemployment. So as inflation comes down, they'll be itchy triggered. And when unemployment rises, they'll be panicking. It's always the same. And I've been in this business 32 years, and it has never been different. We need unemployment to keep rising, which it's doing. It always lags the cycle. If you look at inflation, we look at everybody looks at the trueflation numbers, and they're at 2.34% this morning, I think. So inflation is over. Core inflation always lags. So I don't know what battle they're fighting here. So I think the highest probability is that they're done. I think unemployment will be stickier than people imagine. So employment growth won't come back as fast. So usually out of a recession, you kind of see unemployment rise and then comes back down again. We'll probably see that slower because of this job destruction by AI, that it's harder to get. And then we'll probably see new businesses new business formation picking up as people try and figure out how do I get employed, that kind of stuff. Because you can't go and work in an Amazon warehouse anymore either because they're employing robots.
Raoul Pal comments that throughout his 32 years in this business, he has witnessed a consistent pattern when it comes to the Federal Reserve's actions. The Fed cares about two things: inflation and unemployment. When inflation goes down, they get worried and want to do something. When unemployment goes up, they get scared. It's a predictable cycle that has never failed to repeat itself. According to Raoul Pal, unemployment will stay high for longer than expected. It will take more time to get jobs back than in past recessions. You see, usually in a recession, we see unemployment go up and then down. But this time, because of artificial intelligence, AI, taking over jobs, it will be slower. Also, we might see more people starting their own businesses or doing something different as they look for other ways to make money. This is because even the usual jobs, like working in an Amazon warehouse, are being replaced by robots. Now, let's get into the next clip to hear Raoul Pal's insight on the market.
What I've basically figured out is that I think liquidity in terms of central bank balance sheets is forecastable out to 2 or 3 years. And asset prices, like the NASDAQ, is correlated 97% with our liquidity indices. And therefore, if I can forecast liquidity out 2 years, I can forecast the NASDAQ, Bitcoin, Ethereum out for 2 years. Now, it's still a hypothesis, but it is based around an enormous amount of work about what happened after 2008, I think the big reset that everybody's waiting for happened in 2008. All debts were basically forgiven by saying all interest rates are going to zero. So you don't have no burden to pay your debt. Everybody reset their debts in 2008, and they all reset them into 3 to 5 years. Every government and most corporations. So what you've got is the economy now, every 3.5 years, rolls over as you come through the debt cycle. And every 3.5 years, all of the interest due on the debts gets monetized by the central banks. So they're all monetizing. And I've tested it out and done a load of work. The US, the UK, the EU, Japan, they're all doing the same thing. They're just monetizing the interest payments on their debts, which means they've got a credit card to pay off their credit card interest payments. And that's debasement of currency. So it's not really liquidity I'm talking about. Liquidity is a proxy. It's actually the debasement of currency that's the predominant driver.
The dark clouds overshadowing crypto have lifted in recent days amid a burst of institutional interest and pausing interest rates. But can they return back with the Fed's hawkish decision? Will there be a pause, cut, or increase in rates in upcoming meetings? How will the Fed's decision affect Bitcoin prices and overall market? Let me know your thoughts in the comments below. And don't forget to subscribe to my channel for more updates on crypto and economy. Also, be sure to give a big thumbs up to this video. Thanks for watching, and see you next time. Adios.